We're going to talk a little bit about fixing bad trades today. Excited about that. This is a question that was asked in one of our previous YouTube lives, and so this was a question that was asked in one of our previous YouTube lives, and so we thought, well, let's go ahead and address this and talk about fixing bad trades. For those of you who are at Apiary and you watch the Thursday morning trading rooms, you'll often hear, okay, this trade's going good, or this trade's going bad, and okay, well, now we're in fix-it mode. And so what is it that we actually do when we're getting into fix-it mode, and what are we trying to accomplish there? So that's what we're going to be covering today. Before we get into that, a couple of things. Check out last week's YouTube. We talked about we traded, Todd and I traded during the FOMC announcement. It was awesome. It moved almost exactly like we were hoping it would, and so we had a lot of good commentary on that. I lost a little bit of my internet connection, but we were still able to talk through that FOMC. So that's a good one to watch, especially if you're interested in trading news events. Another thing, we're excited this month. We have two new things that we're doing this month. Later, at the end of the month, we have a Beeline boot camp. This is our first one, and we're super excited. What we're going to do is we're just basically all getting together. We're getting a group of people together here in Utah, and we're just going to crank through all the different Beeline requirements. So we're going to be focused, highly focused. It's a little different from a summit. Summits, are a lot of trading and a lot of training classes, education. But during these Beeline boot camps, we're just going to hit the ground, and we're just going to roll up our sleeves, and we are going to work on Beeline requirements. So we've got some great things planned for that Beeline boot camp at the end of the month, and then dig this, we are going to go on a trading cruise. Right after that, we've scheduled our first Apiary, what we're calling the Life of a Trader cruise. Now, we have been in contact with one of the most technically advanced cruise lines out there, one of the best cruise ships out there. And they say that they've dumped millions of dollars into the internet technology. So I've been on cruises before, and trust me, you do not want to trade on cruises if you can avoid it. But they've promised us that this is like a whole new experience with the internet. So we're going to try it out. We're all going to get on a cruise, and we're going to go to the Caribbean. And we're going to get up in the morning and do some trading. We're going to do some one-on-one work while we're out there with different traders. So we're going to see how that goes. We're excited about Life of a Trader, and we'll let you know. We'll be sure to let you know how that goes. But for now, let's just jump in and right in and talk about fixing trades. So there's a couple of considerations when we're talking about fixing trades. Let me jump over here. So the first thing is one, is the trade live? So let's see, or is it closed? So is this a trade that you're trying to fix because you've closed out, you've made the wrong decision in the market, and the trade's gone against you and you've closed it out, or is this still an active trade? And how you approach the market, in those two scenarios is different. If it's a closed trade, basically what you're looking at doing is just getting into your next trade setup. So you think about each trade setup comes with its own probabilities. So a trade setup may have a 60% probability rate with it. So what that means is that out of that, when you use that trade setup, 60% of the time it wins, 40% of the time it loses, right? So if you close the trade out, then what you want to do is just get into the next trade, whenever that trade sets up again. The reason being is because those numbers will start to play out over and over and over again. Eventually you're going to hit your wins, and you'll make up those wins. Will hopefully, if your trade setup is good, it will hopefully recoup some of those losses. However, if you're still in a trade, there's a chance that you can possibly recover that trade. Possibly turn the fence, so instead of losing, you're actually making some money in it. So we're going to focus on that, when the trade is still on the books, you're still in the trade, what can you do to fix it in the moment? And there are three basic things we're going to look at. Number one is we're going to look at just closing out the trade. Sometimes a close is the best solution. Sometimes it's, the market's not doing what you expect, just close it out, and then get back into your trade setup. Another option that we're going to discuss is what I call a wobble. Basically, you're going to use part of your position size to fix the bad trade. And the third thing we're going to talk about is a hedge. So we're going to go through, and what I'd like to do is just kind of open up the market and show you how we would go about using some of these different techniques. So let's open up the market real quick here. I'll tell you what, one thing we've done in past is we've just had someone come in randomly and get us into some trades, and then we try and, if they win, they win. If they don't do the right thing, then we try and fix it. So why don't I have Cade? Cade's one of our technicians here. Let's see if Cade will trade with us today. Hi, Cade.
Hi.
Great to be with you.
Great to be here.
You ready to do some trading?
I'm ready to do something.
All right. How often have you traded before?
Never.
This is your first time?
Very first time.
You feel more comfortable behind the camera instead of in front of it? And do you feel more comfortable placing trades or not placing trades?
Probably not.
Not placing trades. All right. So just a quick layout. We're going to trade. This is a live account. This is the account that I'll trade during the trading rooms on Thursday mornings. So this is real money, not to make you nervous. You're not nervous.
To know.
So what I'd like to do, like for you to do, is just start trading. Start placing some trades.
Click some buttons.
Yeah. Let's see what we can do. What kind of damage we can do here. This sounds weird, right? We usually want to win, but now we're like gunning for. So on the right side is a buy. So buys basically mean you want it to go up, and on the left side, this is here as a sell. And so you want it to go down. So whatever, just pick a couple, just throw a few trades on, see what you
buy whenever.
Yeah, buy or sell, whatever you want to do. Just get into some trades.
Okay, here we go.
You gonna buy?
I'm gonna buy.
Okay, that's good. All right. So now you're in a trade.
Okay.
You're in one trade. Go ahead and throw a couple more on. So now what we're doing is we've kind of simulated, the market. We've gotten into the trade, and we've gotten into 3 separate trades. And now, now we're like, is this market going to go in our favor, or is it going to go against us? And we'll just kind of watch this and see where it goes from here. We're basically break even right now. So let's see what it decides to do. It's starting to get a little slow, which is makes these YouTube lives interesting when it goes real slow on us. But so okay, now it's starting to go against us. A couple of things. One of the first things that I'll do when I'm in a trade like this is basically go back and look at the overall bias of the trade. So we're in long positions, but if you look over here on the 5-minute chart, the bias for the most of this trading session, or the last several hours, has been on the downside. So it looks like the market could very, very likely could continue lower at this point. And so there's a little bit of a concern whether, this thing's going to actually rally back up and hit, our target, which is up here. So a couple of things is anytime we get it up into profit, if you're concerned about a bad trade, anytime you can get into profit and you can lighten your position size, that's a good thing. So you saw how it just popped up there, and the loss came up to break even. One thing that when I get into fix it mode, one thing I'll do is just close out one of the positions, like right now. So like right here, try and close it out as close to break even as possible. So now what we've effectively done is we've lightened up that position. So, and then, if it continues to go in your favor, that's great. The market, you can make some money on that. Another thing you can do is as it's getting up into, like right in here, you can take a hedge position. So you can take an opposite. So we just entered into a short. And so now what's happening is when that sell starts to make money, or when we start to lose on the buys, the sell will start to make money. So that's the hedge. So first thing we did was lightened up our exposure at as close to break even as possible. The second thing we did was hedged off a little bit of that risk. So now our exposure to the loss is even smaller because when we lose on one, we'll be gaining on the other. So now effectively what we have is one trade exposed in the market. Now we're coming up, it's going to hit our take profits. So now this is another thing. You can see we're still hedged, right? So if that comes up and hits that take profit, we're going to have to close this out as well. So, but let's leave it on because we're now effectively in another bad trade, right? So what do we do here? All right, so another technique that I like to do is I like to wobble. So I'm in one short. The market is predominantly down, right, most of the morning. So what I can do is I can build positions into that short bias and hope that that bias starts to turn that market around. So we're going to start to build a short position, and this may just run on us or whatever. But and then as that comes back down, we'll wobble out of this. So let's watch and see where this takes us. Okay, so we've got three bars up. We're in short position. So what we're going to be looking for is we're going to look for that market to reverse. Now, if you get into a position like this where it's moving against you, you want to identify where all of your resistance levels or support levels are. So right now we've got one support level here, a whole series of support there. If that layer does not hold, then we've got another layer of support right up there. So we're keeping, when we're in a bad trade, we're keeping close tabs on where all of those resistance and support levels are. So if it breaks it, it looks like this might. So we're going to add another short here and another one. And another one, and we're going to build into a heavy short position, and then hopefully for today's example, hopefully it just keeps running away from us, and we can work on fixing it. So now effectively what we've got is a layer. We're building different layers. We got one trade here. We've got two trades here, and we've basically got three trades here. And so this technique is more of the wobble technique, where we're hoping that the bias will give that market some downward pressure. And then we're going to build another layer in up here. Now let's watch how that market moves. It's going to be really slow on us today, I think. So we're going to hold off, wait till it gets up to that red line, and then we're going to start to build another short position. So this is building into the bias of the day. All right, it's going to be slow. So what we'll be looking for here is for any kind of volatility to pick up. And with any kind of volatility, we'll start to lighten up on these positions. Right now, we're taking as big a loss as big a loss as we've seen, or we're at the high, and so our loss is at a maximum right now. So any kind of volatility that spikes and pushes us down, we're going to peel off some of these if we get any volatility. Question?
How do you determine how many trades per layer?
Great question. So right now what I'm doing, so the question is how do you determine how many layers, how many trades per layer? So I've got 1, 2, and then I think I've got about 3 at that level. So the one thing you want to do is make sure that you never exceed your max position size when you're using a technique like this. And so in this account, I like to set my maximum position at about 6. So whatever I build, however many layers I build in here, I'll never exceed 6, or I'll try not to exceed 6. And then you can just kind of play it by ear. So you see how the market's changing from a strengthening to now kind of a sideways movement. So it had an expansion phase. Now it's moving into a consolidation phase. You know, I like to build positions into the consolidations. So I just added 3 more right here. And we're not quite to that top layer, but anytime you get a consolidation, those are potential turning points in the market. Okay. So potential turning points.
So you're starting to think it's going to be going down?
Again, the bias is down for the day, and so yeah, this is all predicated all predicated on the bias of the trade and the fact that we've had an up leg, and we're going to catch the down leg. All right, so starting to move slightly lower here. Zoom way in and clean up these charts just a bit. So we're using technical analysis to determine how to distribute these trades when we've made a mistake, when we've gotten in at the wrong time. And volatility is just really, 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 really small. All right, so now this is our little consolidation right here. It's so small, but that's our consolidation. So if that breaks up, then we're going to be even more upside down on that trade. And so we want to make sure we know where the next layer is, higher. And another thing we want to do is we want to determine where we'll quit ultimately, where if this thing just keeps running away from us, where we're going to ultimately quit. And I think ultimately we want to close out if it rallies up above that level right there. So now it's starting to break higher. See how it's breaking higher?
Mm-hmm.
So we're up at that next, what I would consider that next layer. So we're going to build another position here. Now, this is important. When I'm in fix it mode, I want to make sure that there's enough movement between the highs, where I'm entering that position, and the support of the previous. So right now it should be closing off. I placed a series of trades up there. It should be closing out of those trades right about here, right about now. Now if those take profits levels were down lower, then I probably shouldn't take enough trade at that trade. So if the take profit puts us down below that support level, then that's probably not a good entry point. So we want to make sure that it's above that support level. We want to make sure that there's enough room between those lines, those red lines, to get out of the trades. And it wasn't quite enough, see that?
Mm-hmm.
So we can either close them out manually and book some profit into the account, which we'll just do that real quick. So now we've just booked a series of trades, into the account. So we booked 4 or 5 at 1.6. So we've booked about 10 pips of profit into the account, and we're down 17.
Okay.
So does that make sense? So
Yeah.
what we just did was we just fixed. We used that little wobble to fix that trade. Now it looks like the market's going to drop back down, and again we're in profit here. So let's peel that one off. We're going to take a very small loss on that one. These we're still upside down on. So another thing that I'll do sometimes is if my profits are +3, and these are -3, then I'll close one -3 out and one +3 out. So I'm basically trying to keep that that net loss at 0 as much as I possibly can. So I've got 10 pips of profit right now, and I've got 8 pips of losses right now. So even though we've been wrong, right now we're effectively neutral on that trade, on this trade. So we've fixed the bad trade. Now we can see, once we fix the bad trade, now we can see if we can make money on that trade. Is this making sense to everybody? All right, still moving sideways. Now we're starting to get a little bit of a turn. Okay, so now it's closing out, hopefully, of all of that set. And again, it's closing out of everything. That's a good move.
Right.
All right, so now we can book that one and then book that, and now we're closed. So, so let's just kind of review what we did here. Okay. So your trade worked out really good, ultimately, right? Because the market rallied up.
Yep.
You're a natural. But what we did is we got into a little bit of a pickle, because we put a hedge on here, and then when the market rallied up, we left that hedge on. So we were a little upside down. So then we started building a couple of trades in here, but we're using the bias from the trading day to help give us an edge in the direction that the market is moving. Now, if this trade was completely flopped upside down, we wouldn't have used that strategy. We would have used a different technique to fix that trade. but because the market had a bias to the downside, we're using that to give us the edge in fixing that. And then what we did is we started building, we identified all of our layers, all of the layers where we expected support or resistance to form. And we added trades at those different levels, okay? Then when the market went into this sideways consolidation, we added a couple of more trades, because the basic rule is that the market moves from expansions to consolidations to expansions. We don't know which direction that market would expand, but we were hoping that the bias would expand it to the downside. Okay?
Okay.
Then what actually happened is it gave us a whipsaw right here. And during that whipsaw, we added another layer to that. And this is important. The important thing here is that we have enough to book profits between where we enter on that and the support of the consolidation. Now, if that thing had kept going higher, we would have added layers here, we'd have added layers here, and we'd have added layers here, all the way up to the point where we say no more trades, which was right here, right?
Okay. And those are all just the points where it could take a turn.
Yep, those
we're
are all
expecting it to.
Those are all just potential turning points, exactly. Then what ended up happening in this case was the market pulled back down. We booked all of the pips off of that. So that gave us about 10 pips worth of profit. And at the same time, we were down about 17 pips of profit. So that effectively got us down to a more manageable level at that point, right?
Gotcha.
And then when the market actually expanded, we closed out the rest of the trades, and the rest is history. We made a little bit of money on that trade.
All right.
So, folks, that's what we did is went through the process. We used 3 different techniques. We used a hedge today. So we used a hedge earlier in the trade session. We used a wobble technique where we're building layers into the direction of the bias of the market. And then we also closed out of some trades. So we used the close technique where anytime you get to where you're breaking even on the trade, you're closing out. And so we used all of those different techniques to manage that trade that went against us today. So, so the questions, a couple of questions. Let me just take a look at some of the questions in the chat here. Would these techniques work just as well on other time frames? For example, the 5-minute, 15-minute, and the hourly time frame. Absolutely. In fact, when back in the day when I was managing money, these are the same type of techniques you would use to build and reduce positions. And we're talking large positions, $500,000, $1 million positions. So what you would do is you'd be adding to those positions, peeling off layers of those positions, and all the while you're working the trends that are forming on those charts. And so absolutely, this is what we've done is we've taken those same techniques and we've shrunk them down to minuscule time frames. But they absolutely work the same way on higher time frames as well. Great question. Hedging is not allowed. So Marius, how is hedging allowed to trade in both directions? For a typical retail account, hedging is not allowed. Apiary Fund is an institution, and so Apiary Fund traders benefit because we deal with multiple liquidity providers. So we can hedge between different liquidity providers in the same way you could technically hedge if you opened up if you opened up several retail brokerage accounts, you could send all your long trades to one account and all your short trades to another account, and then have a hedge. It'd be really hard to hedge on these small time frames if you're doing that in a retail account, but technically you could do it, especially if you're managing a larger portfolio. So anyway, that's how we're able to do that. What would you do if the market went the opposite direction? So I think the question here is that what would we do if the market went, if instead of us building into short positions this way, if the market had broken down this way and we don't have the luxury of the bias on the 5-minute chart, what would we have done then? That's a fantastic question. In that case, there are some times when there's absolutely no reason for being in a trade. And the point where you break the lowest lows of the day, right here, if you're caught on the opposite end, on the opposite side of those lows, there's no reason to use the wobbling technique to fix those trades. There's no reason to try and hedge those trades. It's way better to just close out of those trades, take the loss, and then start your new trade setup in the direction of the bias. So again, traders are always looking for that little extra edge of the bias to give them the better probabilities when they're trading. So that's a really good question. How do you recognize the bias of the market? A lot of different ways of, you can use a moving average to help you identify the bias of the market. You can use, we use just the last couple hours worth of the trend, higher time frame charts, trends on higher time frame charts, anything that really gives you the overall direction of the market, whichever direction it's moving, bullish or bearish. And you don't want to go back too far. Like I wouldn't go and get my hedge, from price data 2 weeks ago, because that won't really be giving me much of an edge. But definitely in the last few hours, whatever that market's moving in the last few hours, that would definitely give you an edge. What do you think, guys? Has this been helpful? How many of you think that hedging technique would be? I sure wish Dodd-Frank never passed. I really wish that hadn't passed. It took away one of the best advantages we had as traders, and that was that hedging. The wobble technique, what are your thoughts on that? That wobble technique has saved me tons and tons and tons of money. I'm telling you, that has been very, very helpful in helping me fix a lot of these trades, especially because you don't know, the market can really do anything it wants to, but using that bias and wobbling has always been a huge help. All right, well, let's go ahead and wrap it up for today. Cade, thank you for helping me out.
My pleasure.
You did better than I did. You picked the direction. I missed it. All right, traders, we have a special treat in store for you. It has been 1 year since we started doing these live YouTube live presentations, and so I think we've got a little party scheduled up, or a little party upstairs, and so let's take a quick break and let's go upstairs and see what the guys upstairs have got for us in our birthday celebration. So come on, let's go upstairs. Well, thanks for supporting Apiary Fund on YouTube. We're grateful that you've been with us and supported us for so long. Happy birthday! It's been a year, so enjoy. We'll see you next week.